Can you study the past and learn from it? Can you predict the future if you understand the past enough? Guys, I thank you for taking the time and giving me this attention. I am going to share with you some things that have blown my mind as I've learned them. And this is going to be a longer video. This is a good podcast type of video. Don't watch this while you're like hurrying up in between stuff. Bookmark it, save it, send it to yourself, whatever. Make sure you take a few minutes. This is strictly optional. There's nothing here that's going to probably make or break your current loan. I'm already aware of all this stuff and I'm already advising you on your current loan. But man, this is information that's just been so empowering to me. And I've shared with, I don't know, hundreds of my clients. In fact, I used to share this with every single application, during every single application except before the loans got really complicated. So somewhere around 2011, 2012, 2013, loans started getting really complicated and it took so much more time in the loan application and I didn't have time to share this with people anymore. And so this is what I do now and to share. So hopefully you find this as, I know I'm a geek, I get that. So it's okay if I'm too geeky, you just watch it in super fast mode or something. But I sound better in super high speed anyway. But I'm gonna go ahead and share my screen on a lot of different slides. This is really, really cool stuff. We're gonna start with housing values because there's so much. So I'm going to share some stuff with you, and this will be probably the only time, a lot of this may be the only time in your life you see some of this information. So maybe you want to watch it again, but at least like do what you got to do to remember, make your conclusions, draw your conclusions while you're watching, and save this information for like your family, right? Your friends, the people you care about, like they're not hearing it. So let's go ahead and get started and go from there. So welcome to the journey. Here we go. All right. So first slide, this is a Census Bureau report. This is showing home values from the year 1940 up through the year 2000. Every state in the union is shown here, so you can kind of see what the history is. Of course, we're in Utah, so I'm highlighting Utah specifically. But check this out. This is, I'm gonna make this bigger so you can see it better. But did you know the median house price in Utah in 1940 was $2,300. How would you like, what do you think a house payment on $2,300? It's a lot less than $3,000 a month. I'll share that. But I want you to notice this trend now. And this is a really interesting trend to me now. I have this same table just up above that's adjusted for inflation. And it's kind of interesting because remember, buying power changes as money inflates. So maybe we'll take a look at that before we're done. But 2,300, 10 years later, triple, 7,400. 10 years later, 50% increase to 12,600. 10 years later, a smaller increase, probably 25% to 16,000. 10 years later, what is that? Triple again, a little more than triple to 57,000. What in the world? That's huge. Maybe we'll circle back to that one. Actually, let's talk about it right now. We have, what year is that? 1980. So from 1970 to 1980, home prices skyrocketed. This is very interesting. There was a lot of inflation in 1980. Home prices shot up more than three times. There was a lot of inflation going on in 1970, also in 1980. But that inflation made it into house prices, kind of like we just saw in the pandemic. So that's an interesting moment in time to remember and recognize. In 1990, it increased, another 20% or 10% or something. And then in 2000, it goes up more than double again. Now, where's it been since? So let me go ahead and pull this one up. This is going to be 2010. So the median house price in 2010, and now this is specifically in Utah, is 220,000. So it went up from, 146 to 220. So another increase. And what about 2020? 2020, single family median sales price, 425,000. So it more than doubled again. So the reason I'm showing this isn't, an 80-year history. You've got 80 years of looking at home prices. I have been listening to people for I wouldn't say the entirety of my career, but I've been listening to people for sure since the crash, since 2008 and beyond. I've been listening to people tell me that home prices are coming down and they're waiting for home prices to come down. So you just saw a huge segment of time, 80 years. Now, if we were to go and look at every single year, 1941, 1942, 1943, you're actually going to see years where home prices went down a little bit. But in every 10-year segment, home prices climbed, and in some cases double, some cases triple. Now, it's not a big deal to triple home prices when they're only $2,300. Not to us, but we didn't live in 1940 spending $1940. We're spending $2020 or $2026, right? So for us, $2,300 is pocket change. But for them, it was the same to them as 500 grand is to us today. It's the same house, by the way. And so those homes cost $425,000 in this last, in 2020. And they've gone up since then. I think our median house price in Utah is over 500 grand now. So what lessons can we take from that? What can we know and recognize? Well, I'm not gonna boil all of it down for you in this. I'm just gonna show you cool stuff and talk a little bit about what stands out to me. But I would love to hear your thoughts on it. So feel free to drop some comments in there. I comment whenever I see them. This is a video that I'm going to be showing to all my clients for a long time. So hopefully, hopefully we just have a huge chain of comments. And if not, everybody's just being shy, I guess. So, all right, home prices always going to go up every 10 years. At least that's what they've done for 80 years, right? Who knows for sure? You can never check. You can never know for sure what the future is. But what is it that Mark Twain said? The history doesn't always repeat itself, but it often rhymes, something like that. So that's where home prices have gone. Let's talk about interest rates. Let us see a lot more about interest rates. Now, interest rates, not today, but interest rates from, how about 1790, all right? How is this? So we're not looking at mortgage interest rates. To be clear, there were no 30-year mortgages in 1790, but what there was, this is when the first US Treasury security was sold in 1790. And so we have a 200-year history of interest rates for the US Treasuries. And a lot of people talk about the 10-year note today. A lot of people think mistakenly that that's what mortgage rates are based on. It is a corresponding interest rate. It does walk a very similar path to mortgage interest rates. But to be clear, it is not mortgage interest rates. So let's go ahead and keep going here. Okay, so in 1790, interest rates were what, between 7 and 8%, looks like, if you can see that. And then you can see they kind of came down around 6%. I'm not going to follow the entire history, but what I'm going to point out is this is the 4% line. How often have treasuries been under 4%? And it's really important to know, just a tiny little bit there, but look at this. What was going on between 1902 and 1920? And then what was going on between, 35 and 1950? What happened to interest rates when these two events were going on? What was going on? World War I and World War II. So isn't that interesting? A lot of times, this is a funny, I don't know if it's funny, but it's a weird correlation. In mortgage interest rates, the worse the news is, globally and internationally, and just anyway, usually the better interest rates get. This is World War I, the Spanish pandemic, the Spanish influenza. This is World War II, right? And our interest rates were at the lowest in history. Each of these are the lowest in history. And then, of course, what the heck is this? I'm sure you've probably heard stories about the 1980s. My mom tells me a story of buying a home with a 17 or 18% interest rate on it. So that fits what you're looking at here, doesn't it? It was in, I think, 84 or 83 or something like that, she said. And yeah, you can see that here. What in the crap was going on? Well, this is what happened. So World War II came to an end, but that did not end all the conflicts. If you remember, the Korean War kind of started to escalate, and we never called it a war. I don't understand. I don't think, but we certainly sent soldiers over there to fight, and I guess that kind of ended it. But what started happening was inflation. So we were having a hard time with inflation at that time. That war, as you can see, did not lower interest rates. That war increased them and started to. And we had a lot of inflation between the 50s, 60s, and 70s. And that's what you kind of, well, we didn't have a lot of inflation really until the 70s. And that's why you see interest rates stayed pretty low during this era, but they certainly were climbing as inflation kind of continued. And then you can see here, they kind of start to take on a life that they hadn't seen in a couple hundred years. And then obviously here, this is an all-time high. And this was just that. We were getting inflation in the United States. We were getting what they called stagflation. And I understand stagflation to basically represent an increase in price, but a reduction of production, a reduction of the actual economy. Oftentimes not improving items. We're actually lower quality items selling for higher prices. That has to do oftentimes with a lack of competition in the marketplace. And there was a global, or not a global, but there was a Cold War going on with Russia and communism in general. during this time, and we did a lot of trade with those individuals. And so it was leading to an increased inflation as we kind of dealt with that. Of course, you can see it peaked in a hard way. And this is the era where Paul Volcker in the Federal Reserve took over and became the chairman. He had a meeting, it said, with President Reagan, and said he was going to hike rates 6%. And I think he did it in 10 months, something like that. And you guys that are watching this probably remember 2022 when the Federal Reserve hiked interest rates 5.5% in 18 months. Was it 18? And of course, Paul Volcker and Ronald Reagan, they accomplished their mission. As you can see, inflation peaked all the way up at 16%. Now guys, 2022, or was it 23? I can't remember. October, we registered 9.9% inflation. That's the highest it had been since this era that you're looking at. You probably heard it at the time. That's the highest inflation we've had in 40 years. Well, that's this. What you're looking at on my screen is what they were referencing. 9.9%, but we are looking at 16%. Could you imagine what that felt like? And even still, for a couple of years, the inflation still remained pretty dang high, over 10%. We only had it that high for a couple of months, not even for a full year. It went from 9.9 down to the 7s within a year, and then from 7s down to the 5s within another year. And so we were in a much clipped it much quicker, I guess. But it's interesting to see. And this is where the S&L crisis happened. If you don't know what that is, go look it up. And then this is where you can see interest rates just fell until they kind of normalized. This is where basically the Federal Reserve got on top of the inflation in the United States and got it under control, got productivity fairly good. Businesses was doing really good in the 90s. And so they had a lot to work with. Anyway, let's go ahead and take a look. This ends at 2007 at, what is that, about a little under 5%. So let's go ahead and take a look at something more recent than 2007. So this is going to be 2008 through current. And so if you can see this is a 4%. So this top line is going to be 5. So this is kind of where that 2007 line comes, and you can see it drops under 4% for almost all of the rest of the time. Now you remember on this chart what we were just looking at, how often is it under this 4% line? Very infrequently. But what in the world's going on in 2008? How did we get our interest rates so low in 2008 that they went under 8% like they did in the 2 world wars? And stayed there for so long? Let's go ahead and talk about that. Let's talk about the Federal Reserve. So the Federal Reserve, in comes the Federal Reserve. Up to that point, very few people knew who they were. But in 2008, the Federal Reserve makes an announcement, because if you remember in 2008, we had a housing market crashing. I'm going to share a couple of stories before I go into this next slide. Just to kind of paint this picture more completely. This is mind-blowing. I'm going to share with you, I wish I had this slide I could share with you. It's so amazing, but I did this for a living. Guys, so it was a hard job in 2008 and 9 and 10 and 11. It was a hard job. However, holy crap, it was interesting. In July, I want to say it was July 28th or something like that of 2008, I'm at work, this right here, and I'm talking to some people or whatever, and somebody's got a loan that they have closed. Their clients have gone to the closing table, they signed the papers, and they're trying to get it funded by the lender, and they're not being able to reach the lender. That lender was ABC Mortgage. Cute name, I know. ABC Mortgage had funded $800 million of loans in 2008. I don't know how many home buyers that was. But I want you to understand, these are closed loans. These are people who went to the closing table expecting to get keys and were waiting for those keys. $800 million of loans had signed papers, and ABC closed their doors, locked them, didn't notify their employees, didn't notify anybody. They went out of business. They went belly up. And they are one of, 1,100 of 1,300? I don't even know how many lenders made it to the implosion list, but they were one of the bigger ones. And that was a moment. That what we had been watching. We had this implode meter in 2007, or I think it began late 2007, where businesses would start to go belly up. I remember flashing back a year and a half, getting on an airplane and looking up at the TV news and stuff while you're in the line waiting. and they're talking about New Century Mortgage. I can't remember if they went belly up or they just had some problems, but I was working with New Century Mortgage. I was like, wait, what? And this is early 2007. They were having problems. Well, anyway, fast forward to this July 2008, ABC Mortgage goes belly up and didn't notify anyone, just shut their doors and never came back. So none of those people who had closed $800 million of loans, not one of them got their keys. Every one of them had to reclose somewhere else if they were able to close. So humongous mess, as you can imagine, all over the United States. Well, fast forward just another month. I want to say it was August of 2008. Washington Mutual. I wonder who recognizes this name, Washington Mutual. It'll be fun. You should mark in the comments if you knew who Washington Mutual was before you heard me say their name. I would love to see that, actually. So Washington Mutual was one of the biggest banks in the world. At that time, I think Citibank was the biggest. Washington Mutual was right there with them. Wells Fargo, Chase, that kind of big. Washington Mutual is right there. Washington Mutual goes out of business. How do they go out of business? Crazy stuff, guys, crazy. So Washington Mutual had $323 billion in cash deposits. Wrap your mind around that for a second. Pause and just think. What does $323 billion with a B in cash look like? That's a third of $1 trillion of cash, guys. Now, it wasn't their money. It was our money that we deposited in their bank, but they had that. And if you understand how banking lends or works, they can lend 10, 15 times that, right? So they're lending trillions of dollars because of this $323 billion. Well, they closed their doors. The Federal Reserve actually shut them down. The FDIC and the Federal Reserve shut them down because, and this is actually a really important lesson. So this is a big tangent, but sometimes during the loan process, people will come to me frustrated because we're asking for tax returns and we're incredibly annoying about it, because we're asking for bank statements and we're incredibly annoying about it. Guys, I know how annoying it is. It's really annoying to us too. I am so sorry when we have to come at you with these stupid conditions we ask for all the time. But I want you to understand this right here is why. Everybody always thinks that the bank is just going to give you the loan and that's it. So they're just trying to figure out whether or not you can afford the loan. That is not all they're looking at. They are looking at whether or not they can sell the loan. It's whether or not you can qualify as per the set rules, and then whether or not they can sell that loan. So if you qualify and you fit all the rules, but for some reason they're not going to be able to sell that loan, they're not giving you the loan. So that's a reality. And it doesn't make sense to a lot of people, but let me make it make sense with the rest of this story. So Washington Mutual, they go out of business with $323 billion. Why did they go out of business? Why did the FDIC shut them down? Well, it's because their lending ratio, remember I said they can lend multiples of the cash on deposits? Well, their stock also counted as those assets. So whatever their stock prices were, those were cash reserves. So their stock prices had been something like $50, $60, $70 a share. I don't remember what it was. And it had plummeted to under $1 a share. So when you have whatever you got, we'll call it $1 billion, and you reduce that down by 1/50th, you suddenly have a whole lot less cash. And so their lending, what they had lent out there, was in line with their total value a day before, a month before, a year before. But because their stock prices had fallen so far so fast because of the fear, because of this crashing market that we were in, because that had happened, now their lending ratios were out of whack. They had overextended themselves, and the FDIC gave them a warning and said, you got to correct this. They couldn't correct it, guys. In this era, banks were going out of business so fast, they weren't buying loans from each other. And another mistake that Washington Mutual had made, this wasn't really a mistake. It was just part of who they were. They had done a lot of loans, what we call portfolio loans or niche loans. Loans that they had done their homework and knew that you could make your payments and it would go well for you and them. 92% of their loans were paying on time, which is actually, it's really, really good, right? 92% is a massive amount of on-time payments, but 8% not paying on time is actually a pretty big black eye. But it wasn't 20%, it wasn't 50%, it was 8% of their portfolio was not paying on time. Well, when they came to this moment where they had this massive chunk of their loans were niche loans, there were no other lenders out there willing to buy their loans, because those lenders had to go through each loan one by one and decide whether or not they were willing to do it. And they just didn't have the manpower to do that at the moment. And Washington Mutual couldn't unload billions of dollars of loans quick enough. So they were overextended, they stayed overextended, and they got shut down. So this is the lesson. People that want a mortgage, their loan needs to be sellable or a lender will not give it. If it's not sellable, that lender is then exposed to being the next Washington Mutual. And believe me when I tell you, every lender you've ever talked to, every bank, every credit union, they know exactly who Washington Mutual was. Every one of them. They will never do that themselves. Okay, so make sure you understand that. So if we're annoying you with some paperwork, that's why. 99% chance that's why. We're trying to check a box so they can sell the loan. Period. Okay, we're going to keep moving now from this tangent. So Washington Mutual goes out of business. One more big story before I continue and show you what happened. Lehman Brothers Bank, you may recognize that name. They were not as big as Washington Mutual, and they were just mainly a lender. They weren't really like a bank, so to speak. Washington Mutual was not only national, they were all over the world. Well, anyway, Lehman Brothers Bank also went out of business in September. I think it was September when they filed. So anybody that's listening to this, if you have ever heard of Enron was this huge scandal. It was the biggest bankruptcy ever recorded in the history of our country, and it was highly publicized for weeks, if not months. I don't remember. It was a little before my time, so I wasn't really paying attention too much, but I remember hearing about it. Enron, it was either a $6 or a $9 billion bankruptcy. So the biggest in the history of our country. And it was a scandal. It was theft and all kinds of, illegal activity involved. Shocker. Lehman Brothers Bank. Why this matters to us? Why Enron matters to us? Because Lehman Brothers Bank, when they filed their bankruptcy, it was $600 billion. They filed bankruptcy for 600 times the biggest bankruptcy ever in history just a couple years before. So Washington Mutual, Lehman Brothers, ABC, I tell you these stories to try to help you see the magnitude of this 2008 housing crash that started coming at us, okay? And if you've heard me say all this, then your jaw should be hanging right now. You're thinking, oh my gosh, this was so big. Guys, this was so big. It was such a huge crisis. And now I'm going to go in and show you what the Federal Reserve did about it. So the Federal Reserve decided to step up. They decided, okay, we need to do something. This isn't okay. If we have all these banks going out of business, we're going to have some trouble. And so in December of 2008, they announced that they're going to purchase $600 billion in mortgages and treasuries. And by doing that, by saying that to the market, it immediately increased the price of those, which immediately dropped the interest rates on those. Now, they did that to stimulate the market, to keep demand high despite the craziness that we're facing. And so you can see the Federal Reserve. Now, the Federal Reserve isn't a bank like all the other banks that you think of. The Federal Reserve prints our money. They're the ones that control our money supply. The Federal Reserve printed $600 billion. And then they took that $600 billion and they went to the marketplace and purchased mortgages and treasuries with it. That's what they did. So in other words, they're injecting extra money into the marketplace. And they announced $600 billion, but they quickly changed it to $1 trillion. That became known as QE1 or Quantitative Easing 1. And then a couple years later, they announced, and so if you can see their balance sheet right here, that's what this is showing. Their balance sheet is $1 trillion, just under $1 trillion. And then they make this announcement, as you can see, a very short-term time later, it's sitting and floating around $2 trillion because they printed initially $600 billion, and then they changed it to $1 trillion. So they printed $1 trillion and injected that into the economy, thinking that for all of us that are potentially losing our jobs and we're also full of fear, maybe if we get fatter paychecks, it'll make us feel a little bit more calm. And it worked. It worked, but not enough. So then they announced Quantitative Easing 2, QE2, and they did another $1 trillion. And you can see their balance sheet. And you can see this took, 1, 2, 3, 4 years, right? And then they finally get to this Quantitative Easing 2. This is 1, and then right around here they're like 2, and that's 2. And then right here they announce QE Infinity, Quantitative Easing. We're going to keep doing it, guys. We're going to do it again, but we're going to do it until we need to stop. So not just $1 trillion. We're just going to do whatever we need to do. And you can see they got all the way up to $4.5 trillion that they had printed. And at this stage, the economy had started recovering. In fact, 2011 was kind of the bottom of the housing market. I have some of that stuff here. No, I'm not going to show that. Anyway, that was kind of the bottom of our housing market. We started to rebound in 2012. So they could see by 2014, they're thinking, okay, I think we made it. And they were then trying to just kind of gauge the economy and say, hey, can the economy deal without all this extra money that's been printed? Should we take the money back out of the market? And that's kind of what was going on during this time. You see how it's just kind of flat? And then right here, they make the announcement, hey, we're going to actually start selling. So right here, they say we're going to stop buying, but we're going to keep reinvesting so that our balance sheet stays steady. And then right here, they say, hey, we're actually going to start selling. And interest rates did go up. Our mortgage interest rates went up over this time just a little bit. In fact, let's see. So let's run a little parallel here. Let's go back to this guy, and this is going to be the treasuries, and we're going to look at 2018, helps if I can see, 2016, 2017, 18. So it actually went up a little bit, and then it started to come back down. So this is, during this time, they're kind of testing the market. They're like, okay, we're going to start selling. And when they said that they're going to start selling, sure enough, interest rates climbed. But you can see they only climbed about 0.5%. Actually, that's about 1%, which for all of us doing mortgages, 1% is a big climb. But you can see then they started to fall again in 2019 coming into 2020. Now, everybody here knows all about 2020, I'm sure. And so you can see why they started falling about 2019. But in 2018, they started rising. And so again, 2018, they started selling, and then they kept selling in 2019. Until they stopped right at the end of 2019. So they did this, and they were, I would say, the reason that we kind of4the Great Recession, to be honest. They really kept us out of crisis. It was phenomenal what happened. But we have $4 trillion, $4 trillion of newly printed money in the economy. Well, that's inflationary, and that's what they're concerned about, so that's what they were watching for. And then all of a sudden the pandemic hits. Now, you can see right here how long it took them to inject the $3.5 trillion. We're talking about 4 or 5 years, yeah? But you come over here to the beginning of 2020, and this is, what are we? We're just over 4. You can see within a year, not even a year, they had injected $3 trillion more. Now you tell me, do you think we really needed to inject $3 trillion? Especially when they had done that over here and it was a successful thing. Why do you think that they injected so much money to the economy this time? Now, this was a pandemic. This was a crazy time. All of us, there's so many layers. All of us can tell stories for decades about this. So much going on, right? But then they continued to do it over the next couple years. All the way up until, what did I tell you earlier? Our inflation hit 9.9%. Guys, the leaders of our Federal Reserve in 2020 were freaking nuts. They were reckless. They could have we didn't need 1% and 2% or even 3% mortgage rates. 4% rates would have been fantastic. 3.5% would have been fantastic. We did not need them to go down to 2%. It was fun. We all like it. But come on, now it's kind of put a stint in a stunted the market, right? So anyway, the Federal Reserve, they got all the way up to, as you can see, $9 trillion. And then they started trying to sell them, and now they're currently sitting down around the $6.5 trillion mark. And they're still trying to figure out how to get rid of the existing. So again, they don't owe that money. They printed that money and bought stuff with it. They own $6.5 trillion of assets that they don't need, and they need to give those assets back and destroy the money. That's why we're still fighting inflation even now. So the Federal Reserve did some great stuff here, and then the changing of the guard, the guys did some really stupid stuff here. Of course, they're way smarter than me, and this is just my limited understanding, but whatever. Okay, I think that's probably the lion's share of what I wanted to show. The history behind this, I think, is just mind-blowing, and the lessons we can take from it. And I feel like even when we're like voting and when we're following politics, I feel like this stuff gives so much more information to just kind of context to like listen and think about. So that's where I wanted to share all that. I got a couple more slides I'll share, but they're a little less connected. They're connected still, but they're a little less. And so this is going to show you. So this is still kind of going back to the housing crash. Now I showed you way back in the beginning, right? Home prices and what they've done over time. And so we already talked about homes crashing and home prices and stuff like that. But home prices did go down in 2008, 9, and 10. Why? What was different about that era? And so that's what this is showing. So this is kind of basically showing construction. And so 1.5 million units, 1.4 million units is this line right here. So you can see in 1998, 2000, we got up to 1.6, 1.8 million new homes built. And then you can see it kept on going. Something happened in this era called the credit boom because the population was not. So in this era, we had the baby boomers were in their 40s making the most money they ever made in their lives. And so they were spending a lot. And so second homes, vacation homes, all kinds of stuff were part of this construction. But by this point, you can kind of see it here. This is about where the Gen Xers start to come into the focus. Gen X is over 10 million people smaller than the baby boomers. And so how in the world is 63 million people supposed to fill the shoes of 75 million people? And so they just didn't. And so banks got creative and said, well, we really like the money that we made in these eras. Why don't we extend more credit? And so you'll notice in this era, that's where the student loans started getting really long. That's where credit cards started getting really big with really small payments. And there was some reform kind of midway, right around 2005. They had the FACT Act that kind of changed credit cards and a bunch of things. Anyway, this credit boom extended more credit to more people than it ever had before. And that's where this false floor started to be created. And so you can see the housing continued to climb all the way up over 2 million units a year. Why am I emphasizing 1.5 and 2 million households? Households, people need to occupy the houses that are built. Yeah. So how many households are being formed every year? Well, it's a whole lot less than 2 million and 1.5 million. Let me see if one of these graphs is going to show that very well. So this is a graph showing you household formations, but it only goes back to 2008. So you can't really use that one too much for this one, but you can see how it climbs. So let me see if I can do a little overlap. So we are, what is this, 1.2 million households. So this is the actual number of households created that year. This is a 3-year running average. So that means that these 2 years were pretty big. That's why it's pretty big like this. But you can see this 3-year moving average right here. It's got these 3 years, 08, 09, 10. Those are bad years to compare because that was the housing crash and everybody was freaking out and moving back home and not moving out on their own. And you can see 2011 kind of created a huge rebound because a lot of people moved out of mom and dad's house in 2011. So household formations in 8, 9, and 10 were drastically under 1 million. But how many housing completions were happening just before that, right? 2 million, 1.8. So there were some household formations happening, right? Most likely something to the tune of, 1 million, 1.5 million a year was happening in 2007, 8, or 7, 6, and 5. But it wasn't 2 million, and yet they were building 2 million. That's 500,000 too many homes every year being built. That's what this is showing. So they built too many homes. Credit was extended way too far. The piper had to be paid, and so all of a sudden nobody's buying homes. There's too many homes. There's a glut of homes on the market, and builders went out of business up and down. You can see it just dropped. These are new home completions. You can see how fast it dropped from 2006, 2007, it dropped to almost 500,000. 2008, it drops almost another 250,000. 2009, it drops almost a total of 1 million. 2010, it drops another 200,000. All the way over here to 2011, which I just showed you. We had the most households formed in years in 2011. And here we are, 2011, having the very fewest homes being completed. 500,000 a year across the whole country, right? Where they were completing 2 million a year just 5 years earlier, right? So this is how everybody got caught up. All the houses that had been built here were finally now getting occupied, because a lot less supply is coming to the market. And so these are the homes, and you can see the homes, it stayed pretty small. We finally broke up over 1 million homes created and built in 2015. That's the first time they broke 1 million. Let's go back and see what households forming looked like. So we formed over 1 million in 2012 after forming almost 2.5 million in 2011. So over 1 million, almost 1.5 million in 2013. A little shy in 2014, but almost 1.5 million again in 2015. Meanwhile, they're only building 1 million homes. So 2015 is the first year that they might actually be meeting the needs of the population. So this is the era where we sopped up all the old stuff that was built over here. This is why so many banks had such a hard time, is because builders owed those loans to the banks. Builders went belly up, then all of a sudden the banks lose their money. But now everybody keeps talking about a housing crash. The second home prices bounce back up. Everybody's like, oh, housing crash, housing crash, housing crash. Guys, you can see this is a very steady number. You can see that this number right here, what are we in line with? 1.4, 1.2 million. And yet going back to this, you can see we are forming 1 million plus households a year. Here's our 3-year average, right? So we're forming a couple of low years. This is the pandemic. Everybody moved back home, so this obviously is a big part of it. But if you take that out, we're at 1 million or so a year every single year. The builders are watching the demand and they're being very careful. They are not overbuilding, and they don't want to get left loose, holding the last hot potato is kind of what it comes down to. And that's the same thing this chart's really showing, is kind of the both of them side by side. 2002, household growth is the blue one. Annual completions, that's the number of homes completed. You can see 2006, where it's way out of whack. You can see 2007, still way out of whack, but it's finally in balance, close to imbalance here. And you can see in this case, it's way out of balance, household completion. And there's a lot of this over the last few years. So, because there have been moments where we've completed 2 million households in a year. So anyway, that is, I feel like, really powerful information for those that will watch it all. And if you don't watch it all, I guess I don't judge you. It's a lot of information, but that has been foundational in so many levels of my finances, of my politics, of my everything, that I feel like it's just really, really useful insight. So if you listen to all this, thank you for taking the time and joining me, and shoot me some comments or reply to the email if you got it via email, and tell me what you think. And we'll talk to you later. Have a great day.